The provisional income calculation is step one in determining how much of your Social Security will be subject to income tax. And the calculation takes 50% of the household Social Security plus all ordinary income, plus dividends and capital gains, municipal bond or non-taxable interest, and you add all those together, and that gives us a number that's called your provisional income. And then from that number, we apply thresholds to determine what percentage of that Social Security is going to be taxable. And rather than read this grid, I think the easiest way to do it is through an example. But before I get into that, let's just define ordinary income. W-2 wages from working, IRA distributions are fully taxable as ordinary income tax. Pensions and short-term capital gains are subject to ordinary income tax, and non-qualified dividends, royalties, and a few other things. So let's use an example where we have $20,000 of ordinary income and $40,000 of Social Security income. Well, the provisional income calculation says take 50% of our Social Security. So Social Security was 40, 50% of that is 20. All of our ordinary income, which is 20,000, and add those together, we get a provisional income number of 40,000. Now let's apply the thresholds. The first threshold of 32,000, all dollars prior to that show no taxation. Once you exceed 32,000, up to 50% of those dollars could be subject to taxation. In this case, 50% of this 8,000, represented by the blue box above the first dotted line, means that we have $4,000 of Social Security taxable, or another way of saying it, 10% of your Social Security, because it was 40,000, is going to be taxable. Example 2, let's just reverse it. Now we're heavy on ordinary income and lower on Social Security, 40 and 20 respectively. First thing we do is calculate the provisional income, all of our ordinary income, half of our Social Security. Now we have a provisional income number of 50,000, contrasting with 40,000 in the previous example. Now let's calculate how much of that Social Security is taxable using the two thresholds. And we find that we pay a total of $11,100, or 55% of our Social Security is taxable, simply by rearranging where we're getting our income from. By having more ordinary income and less Social Security, we're going to pay a larger amount in taxes on our Social Security benefits. Let's add in a third piece. It'll seem a little complex, but now we want to talk about cap gains and how that's going to work in this. The synopsis of this slide is never forget that even if the provisional income calculation ends up saying, hey, you have to pay taxes on like all of your income and all of your Social Security, the formula is a little more discreet than that. And it says you're going to do the provisional income calculation and you're going to multiply your Social Security by 85%. Whichever one is lower is the amount of your Social Security that's taxable. So let's take example 3. We've added 50,000 of capital gains. We have 60,000 of combined household Social Security, and we have $60,000 of ordinary income tax. Okay, now we're going to use this provisional income calculation. We're going to take the ordinary income tax, 50% of Social Security, but we need to add that purple icon, the capital gains, on top of that. Our provisional income number now is 140,000. So we've calculated that. Step 2, how do we use that provisional income number to calculate how much of our Social Security is taxable? We're going to use those two thresholds again, apply the thresholds, and we come up with a number that seems a little out of this world. It says 87,600 of your Social Security is taxable, but you've only made 60,000 in Social Security wages. So we have to remember, the other calculation is take 85% of that 60,000, which is 51,000, and you choose which one is lower, and that becomes the taxable portion of Social Security. So in this instance, we're going to use that 51,000. We select the lesser answer.
To watch other webinars, go to BowmanFinancialStrategies.com and learn about topics like Social Security maximization, Roth conversions, and tax-efficient distribution strategies in retirement.